Crafting a personal investment path. Investment advice often promises much but delivers little. Yet, with a clear approach, it's possible to build wealth efficiently, outpacing the noise of self-proclaimed experts. This guide outlines a straightforward process. Assess financial goals, research options, minimize costs, and let growth unfold with minimal effort. The result? A tailored strategy that maximizes returns while freeing time for life's priorities. Understanding the money. Mindset, risk tolerance, and time horizons shape every investment decision. Some thrive on market swings, while others prefer steady ground. A few questions can clarify this. How do sharp market drops feel? They're a passing blip, barely worth a glance. They stir mild concern, but patience prevails. They trigger panic and an urge to abandon ship. When will these funds be needed? Decades away, for a distant future. Within 5 to 15 years, a medium-term goal. Soon, perhaps 3 to 5 years. How much control is desired? Total command, shaping every detail. A general sense of direction, but no daily fuss. A hands-off approach, fully delegated. Mostly first answers. Boldness reigns. Long-term focus and a taste for customization point toward broad market options. Mostly second answers. A balanced middle ground. Funds aren't needed soon, but constant tinkering isn't appealing. Simple, low-maintenance growth funds fit perfectly. Mostly third answers. Caution dominates, often signaling indecision. Short-term needs favor stability, but inaction risks inflation's bite. Steady choices can bridge the gap. Waiting out, the game entirely rarely pays off. The power of effortless growth. Few enjoy micromanaging finances. Life's better spent pursuing passions, travel, leisure, or creative pursuits. The goal is peak returns with minimal effort. Effortless growth delivers this. A time-tested method blending low-cost options and automation. It's not a trendy gimmick, it's a proven strategy praised by experts across generations. This approach shines in two ways. Lower costs. High fees erode wealth over time. Choosing affordable, market-tracking options cuts waste, leaving more to compound. Simplicity. No need to chase trends or react to every dip. A clear plan channels steady investments, letting wealth build quietly in the background. Skeptics might balk when markets falter, tempted to pause or pull back. History shows this is a mistake. Sticking with the plan turns downturns into opportunities, buying low for future gains. Addressing the doubts, some argue it's too risky, fearing a total loss. This stems more from uncertainty than evidence. Risk and reward go hand in hand. Markets have historically averaged strong annual returns. Left untouched, a modest sum can double or triple over decades. The real danger lies in doing nothing, as idle cash loses value to inflation year after year. Choosing a path, simplicity or control. Two routes emerge. One swift and streamlined, the other detailed and hands-on. The first suits those seeking ease. Growth funds launch quickly and run themselves. The second fits those who relish precision, blending market options to match a vision. Both work. The choice hinges on preference. Beyond picking winners, investing isn't about spotting the next big thing. Single bets rarely outrun the market consistently. Emotions or overconfidence often derail them. Even experts struggle to predict outcomes. Success lies in allocation, how funds split between stocks, bonds, and cash, not in chasing individual stars. The structure matters more than the pieces. The building blocks of wealth. Here's a breakdown of the essentials. Stocks. Ownership in companies offering growth potential. Markets average solid returns, but single picks can falter fast. Broad baskets reduce the gamble. Bonds. Loans to governments or firms, delivering predictable income. They steady the ride but yield less and tie up funds. Cash. Safe and accessible in high-yield accounts, yet vulnerable to inflation. It's best for short-term needs, not long-term growth. Diversifying. wisely. Focusing on one category limits resilience. Spreading across stocks, small firms, global players, or property, and bonds smooths the journey. Performance varies year to year, balancing gains and dips. Tailoring to life stages, younger investors can lean heavily on stocks. Time offsets volatility, turning small sums into substantial gains. Closer to retirement, bonds add stability, cushioning against sudden drops. A mix, perhaps more stocks early, blending in bonds later, balances risk and reward. Tools for the job. Bundled baskets. Collections of stocks or bonds, offering instant variety. They simplify the process but often carry higher fees, sometimes lagging the market. Market mirrors. Funds that track indexes like the S&P 500. Low cost, efficient, and steady. They mirror the market's pulse without fanfare. Growth funds. All-in-one solutions that adjust with age. Bold early, calmer later. Minimal upkeep makes them a standout for hands-off growth. Alternative options, real estate or collectibles, tempt some, but they rarely match market returns after costs. For the adventurous, a small slice of funds can fuel speculative plays, kept separate from the core strategy. Setting it up, growth funds offer the fastest start, ideal for workplace plans or tax-advantaged accounts with modest monthly contributions. Market mirrors require a few picks, built gradually. Aim for low fees and a diversified split across regions and assets. Steady, automated investments, small amounts monthly. Smooth out market bumps and lock in discipline. The road ahead. With a plan in place and automation humming, the heavy lifting fades. Wealth grows quietly, leaving room for life's adventures. Adjustments come later, but the foundation is set, a path to financial independence with minimal fuss.